There's a company that acts like a detective chasing down one of the greatest killers of the 21st century. Like the beating heart in Edgar Allan Poe's story, the clues are unraveling. The stock is CDIO and the company is Cardio Diagnostics. We are talking about an artificial intelligence powered precision cardiovascular medicine company, a forward-leaning company that aims to make cardiovascular disease prevention, detection, management more accessible, personalized, and insanely precise. This one has been on my radar before for its amazing promise, and the accumulation of shares by insiders, along with its seeking $17 million in additional funding, should be considered as powerful indicators of what's potentially happening. Here's where it gets really interesting, as the company has recently conducted a study in collaboration with Intermountain Healthcare and the University of Iowa Hospitals and Clinics. The study, detailed in the Journal of the American Heart Association, describes the development and validation of precision CHD, an artificial intelligence-guided integrated genetic epigenetic test for detecting coronary heart disease, CHD. The study involved 3 independent cohorts totaling 2,516 individuals. This is not some small study, as you can see. The beauty of this is that precision CHD is the first integrated genetic epigenetic test for detection of CHD that uses the input from 6 methylation-sensitive digital PCR assessments to determine the presence or absence of CHD. Okay, fair enough. So what the heck are methylation-sensitive digital PCR assessments? Imagine your DNA is like a long instruction manual that tells your body how to grow and work. In some parts of the manual, there are small chemical tags called methyl groups. Think of them like sticky notes that can be added or removed. Now, scientists want to know where these sticky notes are on the DNA, as it can affect how the instructions are read. Methylation-sensitive digital PCR is like a super precise and detailed detective tool that they use to find and count these sticky notes. PCR stands for polymerase chain reaction, which is a method to make many copies of a specific part of the DNA. The digital part means it's super accurate and can count individual molecules of DNA. This helps scientists see exactly where those methyl sticky notes are and how many are there in a sample of DNA. In simpler terms, it's a way for scientists to understand tiny details about how our DNA works, kind of like detectives zooming in on specific clues in a big investigation manual. This will eventually result in patients receiving accurate risk profiles and highly aligned treatment plans for greatly reducing, if not outright preventing, the risk of coronary heart disease. Wow, it's evidently clear that this is the equivalent of buying into a stock that is looking to increasingly silence existing testing mechanisms such as EKG and CAT scan dye test. Revolutionary and groundbreaking are words that we can easily toss around here. Before taking out a small position and as a form of public service, I want to go ahead and provide some balanced, fundamental-based pro and cons to this stock. As always, remember that this shouldn't replace your own further due diligence, nor should it even be considered as a definitive buy recommendation.
Okay, thanks. Here are 3 reasons to consider buying. Green flag 1, performance trends. The stock has shown a remarkable performance over the past year, with a staggering 476.53% increase in the last quarter and an impressive 117.23% increase over the past 6 months. This positive momentum suggests strong market interest and potential for further growth. Green flag 2, low valuation metrics. The price to earnings P ratio is currently at 1.10, which could indicate that the stock is undervalued. If the company can improve its earnings outlook, the P ratio may become positive, signaling potential for capital appreciation. Green flag 3, insider ownership in transactions. Insider ownership is relatively high at 18.68%, indicating that those within the company have a significant stake in its success. Moreover, there has been a recent insider transaction with a 1.87% increase, suggesting that insiders may have a positive outlook on the company's future prospects.
All right, well, not so fast. Here are 3 reasons to be cautious. Red flag 1, financial health and profitability. The company has reported negative income of $11.14 million and a profit margin of negative 94,732.84%, indicating significant financial challenges. The return on assets, ROA, and return on equity, ROE, are also in negative territory, highlighting potential issues with the company's profitability and financial health. Red flag 2, high volatility and risk. The stock exhibits a high level of volatility with a 10.62% to 13.53% range, suggesting a potentially risky investment. The beta of 5.47 further indicates that the stock is more volatile than the overall market. Investors should be prepared for significant price fluctuations. Red flag 3. Lack of dividend and negative fundamentals. The absence of dividends and a negative price-to-sales PS ratio of 4,435.19 highlight the company's struggle to generate consistent revenue. Additionally, the negative earnings per share EPS over the past 5 years and the negative earnings in the most recent quarter and year indicate fundamental weaknesses. Remember that it's crucial to conduct thorough research and analysis, considering both positive and negative factors, before making any investment decisions.
Great, thanks. So I have entered into this position at 12:17 p.m. on February 5th, 2024 at $2.13 per share with a position size of $100, which is about 47.05 shares. In the next coming days, we will take a look and see what the results are. As always, remember that all investments carry risk and that you should only invest money that you are comfortable with losing. My trading in this stock should not be seen as my recommendation that you do so. Do your own due diligence always. Till the next video, take care.